Let's bring in Euro Pacific Capital CEO Peter Schiff. Peter, we were just commenting that the minutes, it's like an ink blot. You can read it however you want to read it. So how do you read it?
Well, first of all, according to the minutes, a rate hike has been a possibility all year long, and it hasn't happened. In fact, if you read the minutes, what it says is that a majority of members, not all, but a majority or most, believe that the conditions may be right for a rate hike in December, but they're not sure. They haven't made up their mind yet. It all depends on the data, and so they're going to make up their mind then. So I don't see how that's any different than anything they've said all year round, and how people could read those minutes and jump to the conclusion that a December rate hike is a lock.
So what do you think happens then, Peter?
Well, I think that the Fed has not raised interest rates all year because they're afraid to do it. I think they're worried about the economy. They don't want to admit that, so they pretend they're going to raise rates, but they keep coming up with excuses why they're not going to do it. And there's plenty of excuses they could use not to raise rates in December. Now, maybe if we get to December and the stock market is near all-time highs and everybody thinks the rate hike is fine, is it possible that they'll deliver a quarter point and then try to talk it back by saying one and done, we're not going to do any more? It's possible, but I think if they do that, they're going to regret it, because I think it's a very dangerous game the Fed is playing, because I do think the economy is decelerating. If they really were data dependent, the data has been coming out bad. Almost all the data that's come out since their last meeting has been bad, including all the data we got this week. I mean, even that overhyped jobs number, if you factor in that the prior 2 months were not revised up, which everybody thought was going to happen, and it didn't happen. For the prior 3 months, we didn't get more job creation than the Fed expected, and these are low-paying jobs. And look at the lousy numbers that have come out, the earnings from the big retailers. The economy is already decelerating, and the Fed still has rates at zero.
Peter, it's Brian Kelly. So I'm curious. So, I mean, basically, I agree with your economic analysis that things are slowing down. My question then is, do you then just outright short the S&P 500? Because I think if the Fed does not raise, the market could be disappointed.
I disagree. In fact, I think one of the reasons the market is rising now is because the terrorist attacks in Europe make it likely that we'll get more QE in Europe, and therefore maybe the Fed won't move. And in fact, by talking about the Fed said today, if they do raise rates, that means that they're not going to raise them very much. So I think it's the easy money that is still propping up the market. And if the Fed doesn't raise rates, the market is going to like that, because that's all this market has. It's all about cheap money, QE. And if we lose that, the market's going down. So,
Peter, walk me through your analysis of what will happen here. I mean, you think that the Fed will probably go ahead in December. You think that we're in a terrible economic backdrop. So does that mean that the economy is going to really be in trouble when it raises rates, but the stock market will continue to rally because they like the Fed hike?
Yeah, well, the stock market's been rallying for years, but the real economy has been getting worse for years.
So we continue with that divergent path, is what you're saying, in terms of the economy going worse.
This is a bubble.
Okay.
This is not a recovery. The Fed has made a major mistake. They have made all the problems that caused the 2008 financial crisis worse. So now if they start to try to normalize interest rates, the next financial crisis is going to be much worse than the one in 2008, because all the problems that caused it are bigger. So that is the reality. And that's why I still think the Fed is more likely not to raise rates in December, but continue to pretend that a rate hike is just around the corner, but that the conditions are just not right, that the data just doesn't support it.
Is this financial crisis that will be worse than 2008, will that be spurred by a Fed rate hike in December, or will that happen regardless of whether the Fed hikes in December or later on?
Oh, it's going to happen regardless, but I do believe that if the Fed hikes rates, it'll happen sooner rather than later, because the sooner they hike rates, the sooner they're going to have to cut them again and launch QE4 to try to reflate this bubble. But I think by then the markets are going to figure this out, and we're going to have a currency crisis and a sovereign debt crisis, and that's going to be much worse than the financial crisis of 2008, because there are no bailouts from that.
Peter, great to speak with you. Thank you for your time.
Thanks for having me on.
Peter Schiff, Euro Pacific Capital.